Hi, welcome back to Father and Son Investing. Today we're going to talk about something a little different than we usually talk about here on this channel. We're going to talk about something that has $3.27 trillion worth of assets in the United States and makes up 42% of all 401k holdings. Additionally, if you're in your 20s, there's a greater than 50% chance that you are invested in this. Today we're talking about target date funds, and specifically I'm going to talk about the disadvantages of target date funds today. Why the disadvantages first? Well, quite honestly, because they get more views. I've done disadvantages and advantages videos on both I-bonds and treasury bills, and the disadvantages videos get about 3 to 4 times the number of views as the advantages videos. What does that say about us? I'm not sure, but you can probably surmise that perhaps we tend to concentrate on the negative. So today we're going to talk about the disadvantages. I will be doing an advantages video of target date funds as well. Today we're going to talk about 4 disadvantages of target date funds. Let's get started. All right, before we get started, I just want to show you quickly what a target date fund is so that we all have this basic background. There's a good chance that you're invested in a target date fund and might not really understand what it's doing. On the Vanguard website, there's a very nice page that illustrates what a target date fund is. I'll leave a link to this in the notes down below. Just know that a target date fund is a fund of funds. That sounds a little bit funny, but what you're getting is a mutual fund that invests in other mutual funds. And it's designed to change as you get older. So let's just look here quickly at this graphic here, which will explain this very well. When you're young, you're going to start out with a lot of US stocks here in red, some international stocks. You're going to get a little bit of bonds. So you can see it's heavily weighted towards the equities or stocks. As you get older, it transitions such that when you get really old, even older than I am, you're going to be invested in very little equities and a lot more bonds and have a lot more treasury and inflation protected securities or TIPS with some cash thrown in there. So you can see that the type of investments that you're invested in will change as you age. This is done as a set it and forget it approach, meaning that this rebalancing process just takes place regardless of what's happening in the market. With that background in mind, then, I want to give you the biggest disadvantage that I see for target date funds, and that is simply that they underperform. They not only underperform the S&P 500, which is expected, of course, because you're investing in some bonds there where the S&P 500 is strictly equities. They not only underperform the S&P 500, but they underperform something called a balanced fund. A balanced fund is kind of similar to a target date fund in terms that it has some equities and it has some bonds, but the balanced fund just stays at a certain percentage. It might be 60% equities and 40% bonds, or 70% equities and 30% bonds. It just depends on the type of balanced fund that you invest in, but regardless, that percentage remains the same. We're going to use this graphic to illustrate this point. This uses Vanguard and Fidelity. Those are the 2 largest target date fund providers in the United States, and they account for more than 50% of the holdings in target date funds. If you had a balanced fund at Vanguard between 2008 and 2022, it would have gotten you 7.8% return. You can see here, based upon the dates, the different shades of red or pink, and each of these have a lower return than just simply a balanced fund. It's even more striking at Fidelity, where their balanced fund outperformed the Vanguard balanced fund. Just what does this mean for your portfolio then? According to an article recently in Barron's talking about the 2040 target date funds performance and the lackluster return, you'll see here that over the past 28 years, 2040 target date retirement fund, meaning people who are planning to retire in 2040, the total return was 750%. Now that lagged significantly behind the S&P 500, which was almost 1,500%. And if you're looking at the balanced funds, 866%. So one of the big disadvantages then for target date funds simply is that their returns lag and they make people less wealthy than they otherwise could be when they get into retirement. Let's move on to number 2. If we go back to this article that appeared here in Morningstar recently, this is from August 3rd, 2023, this author actually goes on to explain why the target date funds are underperforming the balanced funds, and this will be disadvantage number 2. It has to do with international exposure. At Vanguard, their target date funds have 32% of their equities as international exposure versus the balanced fund, which had 0. Now, I don't necessarily think that having 0% international exposure is a good thing, but 32% is, in my opinion, excessive. It's even more so here at Fidelity, where their target date funds have 36% of their equities as international exposure versus the balanced fund, which is 12%. I actually think 12% is kind of a great number. So because of this exposure to international equities, which have underperformed the US market for years now, the returns coming back in a target date fund have been significantly less. So number 2 is their international exposure. The third disadvantage can have to do with costs. Now, this one is a little bit more subtle because the average target date fund retirement cost or expense ratio is 0.51%, meaning if you have $10,000 invested, they're going to charge you $51 per year to invest in that target date fund. I say average there. Now, if you are with Vanguard, I'll tell you that their target date fund expense ratios is very cheap. In fact, I pulled up the Vanguard Target Date Fund webpage where they talk about their expense ratios, and you can see here that they're 0.08%, meaning $8 per year if you have $10,000 invested. Now, you may be thinking the difference between $51 and $8 is not that much, but as your 401k continues to grow, these expenses start to get bigger and bigger, and all of that is money that you could otherwise be investing and growing. So I say this one's a little bit more subtle here because depending on the target date fund provider that you're using, your expense ratio might not be that high. But what I'm encouraging you to do is to go and check what your target date fund is invested in and what the expense ratio is. The fourth disadvantage that I want to discuss today for target funds is really just kind of a generalization of investors rather than considering their individual needs. Because these are a sort of a set it and forget it way of investing, they really take a varied group of investors and just lump them into one common group, which can have some good things. We'll talk about that in the advantages video, but also has significant disadvantages. What am I talking about here? Well, how about risk tolerance? This takes in no account for risk tolerance. You can see here at Vanguard, they'll give you an idea of what the risk is in these balanced funds. Of course, the risk goes down as the balanced fund gets closer to your retirement age. However, what if you are an investor who has a rather large risk tolerance? You're willing to lose 20% of your investments in a year in order to gain 40% over the next few years. However, what if you're an investor like my mother who really can't stand to lose any of her investments? So if you take all of these different risk tolerances and lump them into one, you'll see that it's not really meeting the needs of all of the investors there. How about similarly age at retirement? This is a date of retirement, 2030, but one person might be retiring in 2030 at age 55, and another person might be retiring at age 75. And that lifetime of how long this investment needs to last obviously is quite different for those two investors. Here's another example. These funds I mentioned earlier are designed to just change, meaning change their asset holdings regardless of what the market is doing right now. Here's an example of this. If you're paying attention to bond funds, you know that the prices of bond funds have just been cratering. So if you're watching the value of your bond funds in your 401k, you're probably crying because you've lost a significant amount of money. However, what that also means is that it's a great time to purchase bonds because the prices are low and the yields right now have been higher than they have been in a decade or more. So a target date fund might not take into account what's happening there and would just be selling off your equities and buying bond funds, regardless whether it's a good time to be buying bonds. So that's what I mean by kind of this generalization that takes place with a target date fund. So again, disadvantages that we talked about today. Number one, the returns just aren't there compared to the S&P 500 and even a balanced index fund. Number two, The reason that they're underperforming has to do with their international exposure. We talked about 36% in Fidelity versus 12% in the Fidelity Balanced Fund. Their expense ratios can be higher depending on who the target date fund provider is. I would encourage you to check your 401k and see how much you're paying for your expense ratio. And finally, kind of this generalization, lumping this varied group of investors into one pot to provide their investing needs. I hope this information was helpful for you. If it was, please give us a thumbs up and please share this information with a young person in your life, especially if they're in their 20s. As I mentioned earlier, more than 50% of investors in their 20s with a 401k are invested in target date funds. Their returns are going to be much, much lower than they could have been, and thus their wealth is just not really going to grow the way it otherwise could have. Until next time, enjoy your investing.